We don't typically do keynote addresses at this event because, frankly, most of our speakers are usually keynotes at other conferences, and we find the most interesting dynamic that occurs is the dialogue between a select group of experts. But Kyle Bass is certainly worth making an exception for. Kyle is the founder, principal, and portfolio manager of Heyman Capital Management. Many of you recognize Kyle as one of the two most successful investors who foresaw the subprime crisis and earned hundreds of millions of dollars for the investors in his fund. Others of you will recognize him for moving behind-the-scenes central banking discussions about the likelihood of sovereign default from a world of concerned whispers and obscure academic papers into the headlines. As an investor who's well-positioned to wage that bet, as well as a concerned individual actively and relentlessly warning about the risks and unsustainability of federal deficits. But here's how we know Kyle. He's a true visionary. I mean, he's the real deal. And he has the courage to follow through on his convictions. He's brutally honest, which frankly scares the crap out of most of us, as you'll see today. But if you ask Kyle for the truth, refreshingly, you'll get what you ask for. And finally, you'll see that he's an incredibly humble and genuinely nice guy, which is not only rare in the world in general, but in investment banking, he's an endangered species. So please welcome back to AmeriCatalyst for the fourth time, Kyle Bass. Thank you.
Well, that was a very nice introduction, Tony. Thank you. I enjoy coming here to Austin, to this conference particularly, and many others around the world I don't enjoy so much, but I really enjoy Texas, coming to Austin, and I love Tony and Todd, and I hope you like what I have put together for you today. Listening to the conversation between Josh and the group beforehand, I have so many objections to what I heard, so I'm not going to get into that. I'm just going to stick with what I have to say. What I'm going to talk about today, it's a little bit more, not really a rehash of what's gone on in the past here, but I'm going to focus on something as the debt problem more collectively, and I know we've probably beat the debt horse to death, but I'm going to talk about it in a few very specific areas around the world. And for those of you that followed or have read the book The Swerve, or are focused on the history all the way back to antiquity, the title of this presentation on the financial nature of things is a kind of a play on words against Lucretius's original poem of the nature of things, which was deemed to be heresy against the church. So this is kind of heresy against the orthodoxy of economic thought to a certain extent. So we'll get into what we're going to talk about today. These are the points I'll go through, and I'll get through them fairly quickly. But we're going to talk about a little bit more about the money printing, because I think some of the things weren't covered in the last session. And we're going to talk about central bank balance sheets. We won't belabor Euroland. We know what's going to happen there. Then we're really going to get into the psychology of the situation, because in many of these situations, the quantitative analysis, in my opinion, is already done. It's just a question of when will this unravel and how will it unravel, which I think is the key when you're thinking about the chronology of events or the likelihood of events going forward. And then we will talk a little bit more about Japan. And then I'm not going to talk a lot about non-agency mortgage debt. Brandon, who works with me closely at my firm, is going to cover that a little later today. But I'll go over a few of the reasons why we think that's a great place for your money going forward. So something that I think is really important to pay attention to, in the last 10 years, debts around the world, this is total credit market debt, so this is on-balance sheet sovereign obligations, corporate debt, household debt, has grown from 80 trillion to just over $200 trillion. So debts have grown at almost an 11% compound annual growth rate over the last 10 years. We sit today at the largest peacetime accumulation of debt in world history. One of the things we talked about in the back after the last panel, and very few people are willing to kind of go out there and say this, you know how this ends, right? this ends through war. And it's, I don't know between who and who, but when you think about war, it's economic entropy played to its logical conclusion. We don't have a playbook for the enormity of debt at 340% of global GDP. And that's why we have such a hard time thinking about how this plays out. But I can tell you that, I don't know who's going to fight who, but I'm fairly certain in the next few years that you will see wars erupt, and not just small ones. We kind of think about what I just went over looking at the right column here. Global credit market debts have grown at 10.7% annualized for the last 10 years. Well, global population's grown at 1.2. Real GDP has really grown at about 3.8 or 3.9. I mean, when you think about the absurdity of what's just gone on in the last decade, all we've had is a debt-led boom. And now we all know that we went through the financial crisis in 2008, but Europe, as it stands today, hasn't gone through this crisis yet. We can talk about the fact that we think they've gone through it. But think about this. Europe's banks are 3.5 times more levered than ours are, and they haven't recapitalized them yet. We just went through a situation where we had about 15 trillion of banking assets and about $1 trillion of equity in the US banking system. This is ex Fannie and Freddie, ex off balance sheet. And for all intents and purposes, we just recapped our entire banking system. Through preferred and common equity injection, we injected $882 billion of that trillion. We almost recapped our whole system. Europe hasn't done anything yet. And we talk about Germany as being the island of fiscal rectitude. Germany has 82% on-balance sheet sovereign debt to GDP, and their banks are 340% of their GDP, and they haven't recapped them. I mean, is Germany really this island of fiscal rectitude that we think they are? They're not. I mean, they've actually defaulted twice in the last century. So don't let these anchoring biases get you where the press constantly repeats something. It becomes axiomatic over time. You have to really think about what's going on over there. Because if you spend enough time over there meeting with the bureaucrats, you'll start to believe that what they're telling you is true, and it's just not true. So this is a telling slide, in my opinion, when you look at the enormity and the rapidity of debt accumulation vis-a-vis just pure population growth or even real GDP growth. I know we talk about this a lot, but one of the points that I try to make is, this is, for those of you that can't see on the back, it's real simple. It's the Ned Davis piece that shows total credit market debt to GDP in the US, just to use it as an illustrative point. You see the Great Depression on the left when the denominator was falling as well as the numerator was rising. But the point being is, for the better part of 60 plus years, the US sat around 150%, 160% total credit market debt to GDP. And then in 1972, we abandoned the currency's convertibility in any fixed asset, and that happens to be the bottom of the hockey stick. So now again, in the US, we've had limitless credit creation, and we sit at a point, like the rest of the world, where we've never been before. And to think about what's happened in the past, if you study history, what you see is when nations get to, sovereign nations get to 250% total credit market debt to GDP, they're both deficit spending going into a war. That's typically what you've seen in the past. And at the conclusion, to the victor go the spoils, and to the loser goes defeat and default. That's the playbook that we're actually familiar with. The one we're unfamiliar with is when these numbers get to 350% credit market debt to GDP, and it's all peacetime. So now we have no idea what's going to happen. Central bank balance sheet expansion is really important. We talk about money printing. Today, central bank balance sheet expansion, the 4 largest central banks of the world are now 13 trillion on balance sheet. From the beginning of the crisis to today, they've expanded by 10 trillion. $10 trillion is being created out of thin air. I'm dollarizing the FX. How are we supposed to think about that? Well, I know we're all worried about it. I know we're worried about it in the fiduciary positions we sit on professionally, as well as the fiduciary position we have for our families, and just about everything else that we think about with regard to our portfolios, our jobs, our lives. But you're starting to see the first signs of what happens when you expand central bank balance sheets limitlessly. If you see the CPI prints, you see the industrial production prints around the globe in the heavily indebted nations, what are you starting to see? You're seeing CPI prints much higher than expectations, and you're seeing industrial production prints much lower than expectations. If you just look at it again, from a third party's perspective and look at it collectively, you see that we're starting to get there. We're starting to get to this bad kind of inflation, the cost push. The misallocation of capital via governments, and you're seeing cost push. Well, that's how this happens. So going forward, that's going to happen a little bit more. We're going to continue to expand balance sheets, as we've seen. Now we have the ECB doing limitless expansion via the back door. We have the Fed saying we're going to buy mortgages as the national pastime. And the BOJ and the BOE, and the BOE owns 30% of all gilts out there. And it hasn't changed their employment picture. So going forward, the political answer is always going to be expansion. The Euroland bank run, again, not to belabor this point, I probably shouldn't even put this in here. One of the points that I'll make, though, is even with the advent of the LTRO in February, something that was interesting to us as we follow peripheral capital flows, they didn't slow down. They kept running. They kept running from Spain. They kept running from Greece. All the deposits were still running when the European leaders were victory lapping on the back of the LTRO. This was that interesting discussion from the last panel. This is a graphical depiction of current account surpluses and deficits of the European nations in the last 10 years. And I don't know if you can, it's a busy chart, but basically you see Germany, Austria, and the Netherlands on top, the pigs on the bottom. And it's interesting to me when you look at the amplitude of the collective current account surplus and deficit, I realize that Europe trades with the US and Asia and China, Japan, but it sure looks to me like Europe just trades with itself, looking at these imbalances. It's pretty fascinating to me that the amplitude of both of those seems to be pretty close to one another. So when we think about private sector leverage becoming a public sector problem, back in 2008, when we were trying to understand this transference of risk from the private balance sheets to the public balance sheets, very few people, in fact, I couldn't find it when I went out looking for it, had done the work to try to understand on-balance sheet debts and then the acuity of the banking system problem. So when I was thinking about how to get my arms around how this is going to go forward, we were saying, okay, let's forget about contingent liabilities. Let's forget about social welfare. Let's forget about promises that have been made to various people in various nations. Let's just look at on-balance sheet obligations, and let's look at how big banking sectors are in relation to GDP. And actually, GDP is a pretty good homogenizing denominator. We tend to use central government tax revenue as a better denominator because certain countries are much more productive than others, in our opinion. But for illustrative purposes, we'll use GDP on the y-axis here. I'm going to go ahead and go forward one because in 2008, the end of 2008, when we aggregated this data, once the data was aggregated, this is prior to Rogoff and Reinhardt writing their book, I had read all the white papers on debt sustainability I could find. And I went and met with Rogoff in February of 2009 and delivered our work to him here. And I said, I'm looking at this and it's really, really worrying me. And if you remember February of 2009, we were mostly focused on which bank was going under and who was going to bail this bank out and that bank out and how the financial system is going to stay together. But I was more worried about what was going on the sovereign balance sheets. When your banking system gets to 10 times your GDP and you lose 3% of your banking system, you're finished. And that's what happened to Iceland. It's what happened to Ireland. It's really what happened in a number of different nations. And now, look, some of these countries still haven't restructured their banks. And so when you have banking systems that are as levered as they are and on-balance sheet situations as bad as this, no wonder France is a big proponent of the euro. I mean, as soon as we start restructuring other banks in Europe, France is going to be the one that's on the front cover of the problem. And France won't be part of the northern euro if they divide it up into two. That's not what we think is going to happen. But bottom line is, this was an interesting way to look at the world. When you look at on-balance sheet debts in blue, banking systems in red, and the enormity of the problem. So at the top of what's going wrong with the world, no one was paying attention to how large these systems were getting. You know, in February of 2009, when Rogoff looked at this, he said to me, I can hardly believe it's this bad. And I was thinking, oh shit, who's paying attention to the size of host countries' banking systems? Because if you, the father of kind of sovereign balance sheet analysis, isn't, well, then I know who isn't. And clearly at that point in time, no one had thought about that. And clearly, we're a small shop in Dallas. We're not the I think smartest people in the world. I was just trying to get our arms around kind of the enormity of the problem. In February of 2009, I hadn't done it yet. So I don't know if that makes you feel better or worse about where we are today. It makes me feel worse, but we get into changing the y-axis. When you think about the nonlinearity of debts, so this is something that's really important to us at Heyman. So one of the comments made, I'm only going to go after one person here. One of the comments made on the last panel was it is always a willingness to default or pay. It's always a political decision, and I would just say that that's false, and here's why. When your debts get to be 25 times your central government tax revenue, a nonlinearity develops between your revenues and your expenses. So if you try to inflate your way out of this problem, which again, the academics, the central bankers of the world believe that when you get to this proverbial fork in the road, and that fork is either inflate or default, and that those two roads are mutually exclusive of one another, we tend to think that 90% of the time one causes the other. And when you develop this nonlinearity, which is seldom written about, I can't find any academic research on the subject, but when your debts are 20 times your revenues, if you try to inflate your way out of this through revenue and it moves your swaps curves or your debt costs, okay, your expenses grow exponentially while your revenues grow in a linear fashion. This just makes sense. Like, this is logic. So when you think about Japan, you know, they've got 24 times their central government tax revenue in debt. If Japan ever moves to an inflationary bias, they're finished. The swaps move 200 or 300 basis points, and they'll spend more than their central government tax revenue on interest. Well, again, that's, if you're trying to define the Keynesian endpoint, it's when you spend more than your revenue on interest alone. And it's far in front of that definition. So I would argue that the Russian example that was given was a very good one, yes. They didn't have a willingness to pay. They just said, we're not going to pay. But when you have developed nation sovereigns that have 10, 15, 20 times their central government tax take in debt, it's not their decision to make. And in fact, if you try to inflate, default is the next logical step, and you can't fight it. So we were just trying to understand who was who in Europe and found some pretty funny comments, and decided to put it on a slide here because when we were trying to figure out who was most like Greece, we really couldn't figure out who was who. So it is pure comedy when I just spent 2 weeks in Europe, and that was pure comedy as well. Moving on. Again, your time frame, when you think about how to assimilate this data as a fiduciary or as a corporate CEO or just an investor, the time frame is really important. And when you think about Kahneman, I don't know how many of you follow behavioral psychology, but Kahneman at Princeton talks about, you know, anchoring biases and optimism biases. And when you have a bias that basically the availability heuristic that he talks about is that we as humans tend to just function and assimilate data with recently available data sets, and we don't look at a larger data set or think about it more as the third person or even go further into history to develop a better data set. What this shows you, and this is a piece out of Rogoff's work, is that, you know, these cycles of sovereign restructurings are really every 70 to 100 years. In fact, that's the word century comes from the word saeculum, which means a good life, and that's typically 80 to 100 years. This is how it happens. And back just post-World War II, 48% of the world restructured their sovereign debts. 48% of the countries in the world were not just decided to restructure their debts. Well, we don't remember that. We don't remember really the formation of the IMF and Bretton Woods. I don't see anyone in here old enough to remember that. But again, this is what's going to happen going forward. You're going to have non-elective decisions as civil unrest. If I'm right about all of this, what's going to happen? Well, you're going to see more social unrest. I know the guy from the Peterson Institute was saying, you saw a few riots in Greece. No, you saw huge riots in Greece. And you're seeing huge riots in other parts of the world over food and lack of food. And those are actually secondary and tertiary derivatives of the financial problems, in my opinion, that we're seeing. We're exporting inflation to some other nations. So going forward, it's going to be a problem. The psychology of the situation is the key. You have to understand, in my opinion, a few things. The optimism bias is something I encounter wherever I travel around the world. So I just spent 2 weeks in Europe, and this resurgence of nationalism that you're seeing in China and Japan is really scary to me, because they're fighting over some rocks, right? The Senkaku Islands don't have any natural resources, and it's really just chest pounding by China and Japan. And going through Europe, I encountered something really interesting in the last couple of weeks. I encountered nationalism from their perspective. And when I wanted to talk about their issues and their problems with various bureaucrats and European investors, they said, well, why do you want to talk to us about that? Let's focus on the US and its problems. You realize Europe as a whole collectively still runs a small trade surplus, and our on-balance sheet debt situation is not as bad as yours. You guys are the ones that are really blowing this. It's not us. And that was an interesting conversation to have with people that haven't restructured their banks. And of course, they don't have a Gaussian distribution within Europe of their banking system and or their on-balance sheet debt. So the optimism bias basically states that it's never, humans have a tendency to believe that things are never going to be as bad for them as they are for others, and then we all tend to have this bias. And I encountered that back during the subprime crisis in the US. I traveled all around the US, and I'd go to Chicago and Seattle, and they'd say, oh, we agree with you wholeheartedly. It's not going to happen here because we have Microsoft as an economy, or we have oil and gas here, or we have this tech industry or that, but we realized the rest of the United States is completely screwed. I heard that in every city I went to. And it's because each person I was talking to actually had a house in the city I was in, and they didn't want to admit that it was going to happen to them. That's what's happening in Europe. It's what's happening in Japan. So the optimism bias is key. Pattern recognition is really important to us because how many times you hear US housing was never going to go down, right? Things that are repetitive in your mind become axiomatic through induction, basically, right? You hear it enough times, then you just start believing it because everyone agrees that that's the case. A perfect case in point today is, how many of you in here hear that Japan's self-funding, as long as they run a current account surplus, they can self-fund? Well, they're not self-funding. It's a complete fallacy, and yet people take it as an axiom. And I'll get into that a little bit later. But the psychology of the scenario is really important to understand, because the change in the qualitative inputs of the participants is actually what perpetuates these scenarios into going from benign to malignant, or benign to a 5-alarm fire. So I think the psychology is key going forward. The first inalienable right of human nature, of course, is self-preservation. And I think that is the last key to trying to assimilate the data set the way that I see it. And maybe we're wrong about all of this, but it doesn't forward anyone's self-interest to believe that what I'm saying is true, right? Because if you believe what I'm saying is true, and we're going to see a number of sovereign restructurings across Southern Europe, and Japan's going to restructure, and the social fabric of the world is either going to be stretched or torn, well, that doesn't help any of us. It doesn't help me. It doesn't help people I care about. It doesn't help people you care about. It really doesn't help your job, right? We start thinking about the logical repercussions and the concentric circles of, let's say, this outcome being proven correct. It's not good for your portfolio. It's not good for your job. It's not good for your family. Therefore, we just don't even believe that can possibly happen. And that's why, in my opinion, there's this general reluctance to believe that something like this can actually happen, because we say, well, Ben Bernanke was Times Man of the Year. He can do it again. He can just keep printing money. Well, we know where that gets us over time. And I think it's going to start happening in the next 2 or 3 years. You're really going to see disconnects in pricing and economic activity. But you remember when Juncker, by the way, they're not going to tell you when this happens. You're going to have to see it for yourself. How many of you remember Mexico in '94 when we had the tequila crisis, right? I'm sure some of you in here were doing a lot of business in Mexico or close. The government gave affirmative determinations that they would not devalue, they would not default, almost daily. And the day after they said we won't devalue, they devalued 60%. The government's never going to tell you that it's going to happen. Juncker, when asked I think it was 2010, I can't see here, was asked if there was a secret meeting to discuss restructuring Greece. He said, oh, no, there's no meeting. And then they talked to 2 other finance ministers the next day and said, oh, yeah, we had a meeting, and Juncker was in there. And so the press went back to him and said, hey, you told us there wasn't a meeting. And he said, look, when it becomes serious, you have to lie. you have to realize that these guys are never going to tell you the truth because they can't tell you the truth. That's their job, is to promote confidence. It's not to tell you the truth. Mervyn King gave a speech just a couple of months ago that I thought was fascinating back on that confidence issue, because the central bankers are all trying to maintain confidence in their local markets. And this didn't receive a lot of press, but in a speech to the British Bankers Association in London in June of this year, just a couple of months ago, he basically says, I added the emphasis in bold, where there are debtors who cannot afford to repay, there are creditors who will not be repaid. I know it's a profound statement, but coming from one of the 4 central bank leaders of the world, I thought it was pretty profound for him to actually say that. And if you read what he's saying here, he actually says, with $1 trillion of liquidity coming in from the ECB, it's proven that it's not a question of liquidity, it's a question of solvency. And until we address these issues, things are just going to drag along the way they are. It's interesting to me to see one of the 4 central bankers say something like this. Let's just talk about Japan a little bit. We all know Japan's on-balance sheet debt situation is now 240% debt to GDP, 25 times central government tax revenue. They have over a quadrillion yen of debt on balance sheet. So that's a 1 with 15 zeros after it. If you were to try to count to a quadrillion, and if every number only took you 1 second to get there, how long do you think it'd take you to count to a quadrillion? 31 million years. There is no chance the Japanese can ever repay their debts, plain and simple. And they will have a crisis. They will have a bond crisis in the next 2 or 3 years, in our opinion. It'll be a big one. That nonlinearity problem that I discussed earlier, I tried to illustrate it in the top chart. And it's a dual-axis chart. It's a little bit busy. But using the red line on top, the red line uses the right y-axis, and that's in trillions of yen. That's just the interest check Japan's writing for its bonds. Now, mind you, as you know, looking at the bottom here, their discount rate, they went to a full 0 on discount rate in the mid-2001. They essentially went to a 0 mid-96. So you have a debt stack where their weighted average cost of capital is sub 100 basis points. And you see in the blue columns are incremental JGB issuance. So forget about stock. This is flow. These are new bonds they're issuing. That uses the left y-axis. The key here, what I'm trying to show you graphically, is what the nonlinearity looks like when it develops. So they issued more bonds than they've ever issued from 98 to 05. And yet their interest costs were collapsing because their capital stack was still refining at lower and lower rates. Well, now we've already hit the full 0, and you see an exponential move in their interest expense, and yet their rates are still 0. In fact, their rates are at all-time lows today. They spend 10.5 trillion yen on interest. They only bring in 40 trillion yen, 42 trillion yen in central government tax take. They spend a quarter of what they bring in on interest, and their debt's free. This is what the nonlinearity looks like. It is so easy to see. It's the most obvious thing I've ever seen in my entire career. It's just a question of when. What people miss, in my opinion, what the big players have missed in Japan, is when you think about what a current account surplus is, that is their balance of trade and their full current account bringing in more money into their economy that didn't exist in their economy in the past, right? They're actually bringing in other currencies, which is currency strengthening for them. But that money turns into corporate profitability, and that turns into wages and corporate deposits. And those wages and corporate deposits, either at the bank or the life co level, end up buying government bonds. So again, back to this old axiom that people deem to be, or hold to be true, as long as I've heard 100 times, as long as Japan runs a positive current account surplus, they can continue to self-fund. Well, that statement in itself has some naivete in it. If you're not going to pay attention to the amplitude of the two numbers, you're doing yourself a disservice. If you're running a current account surplus of less than 1% and a fiscal deficit of 10.5%, you're not self-funding, okay? So you can't just take the statement at face value. The point being, for a long time, Japan's current account surplus exceeded their incremental need for new capital. So their current account surplus exceeded their fiscal deficit. Well, that, of course, is not true any longer, and we believe their current account, I think on this next page here, we believe their current account will be in a full negative position by Q3 of next year. This will be a qualitative input that's going to be really problematic for them. Their balance of trade is deteriorating at twice the rate that even we thought it was going to deteriorate at, and we're pretty punitive on them this year. And so we think sometime by Q3, Q4 of next year, they'll have a negative current account, which means they'll actually be, they won't be a capital importer. They're going to have to be, well, they're actually going to have to be either a capital importer, they're going to have to print more money at the BOJ. They are buying, just to put this into perspective in Japan, they're buying, they're issuing 44.5 trillion of JGBs each year. The central government, through its special asset purchase program, is going to buy 29 of the 44 this year. They're buying a huge amount of the new issuance, and then the banks are buying the rest and levering themselves some more. So it's interesting to me, again, they're not self-sustaining. They're literally expanding central bank balance sheets to get there. We recently had dinner. I'm going to see if this slide's on here. I'll get to that slide. We recently had dinner with the deputy governor at the Bank of Japan, Nishimura-san, and he had just finished at the dinner. There were about 10 of us there. He just finished dinner, and he had denounced money printing or quantitative easing. And we said, wait a minute. When you expand your balance sheet to buy your own bonds, we call that money printing. What do you call it? And it was a pregnant pause for about 10 seconds while I conferred with his attaché, and he came back and said, you know, when the market tells us it's money printing, then it'll be money printing. When the rates go up and not down when we buy bonds, then it's monetizing the deficit. And I said, oh, dumb me. I mean, I guess it's interesting to me that literally they can talk out of both sides of their mouth. Their central bank balance sheet is expanding at an enormous rate, and they're buying their own bonds and printing their own money, and yet they denounce monetizing deficits. Again, it's unbelievable for them, for everyone in the world, to buy what they're saying. Oh, sorry about that. I need to go back. So what did Madoff teach us a few years ago? Right? Madoff taught us something real interesting. The U.S., in the U.S., we know we can't fund Medicare A through D. I think everyone in the room knows this, right? There's no way we can pay for Medicare A through D and Social Security. We're going to have to abrogate those contracts. We're going to have to change how it's paid at some point in time. I know there'll never be political will to do so because it's suicide, but we can't pay for it. But why do we have to not deal with that today, right? We have more dummies entering the scheme than exiting. Well, that's what Madoff taught us. As long as you have more people entering than exiting, you really don't have to deal with the issue. In our opinion, that dynamic has changed in Japan. So their population peaked at about 129 million people. It's now about 125. They're the most xenophobic, homogenized population of any developed nation in the world. They have less than 3 million of 125 million people are non-Japanese, and they're throwing those people out because they're afraid they're taking Japanese jobs away. So here's the problem. They have to live up to their promises today. The cancer on their income statement is the Social Security funding gap for the Japanese retirees. If we're right about all this, what would you start seeing? Well, last year they sold more adult diapers than kids' diapers in Japan. Well, that makes sense. They're having adult diaper fashion shows, as we're showing you here. This is what it's going to look like. If we're right about the population demographic problem in Japan, what would you expect to see on the pension side of things? Right? You would expect GPIF, Japan Post Bank, the life cos. You'd actually expect them to be paying out more than they're bringing in, right? They'd be having to pay out redemptions for people that are dis-saving as opposed to saving. Well, that's happening. It's happening right now. It's happening in many different press releases. Why would you ever buy a bond? Why would you ever buy a 10-year bond with 80 basis points of nominal yield? Well, I don't know if anyone in here would. I would never buy that bond. But if the central bank were to promise you deflation for the next infinity of 1 to 2 points, then you get 80 basis points of nominal yield plus deflation. You have a real yield of 2 or 3%. I guess you might hang on. But how would you put a fail-safe in place? Well, the institutional community of Japan put a fail-safe in place entitled the Banknote Pact, which is not really written about a lot. But there was not a lot of science behind it. It was just a really big number. The Bank of Japan agreed to not monetize more debt than exists currency in the system. So there's about 80 trillion yen of currency in the system of Japan. And they just broke the Banknote Pact in August, just a couple months ago. What does that mean? Well, it doesn't mean that much. It's just like the US having a debt limit. When we get to the goalpost, we just move it, right? So they have this Banknote Pact. They've monetized more debt than exists in the system. But this is a qualitative slip from the institutional community's perspective. again, if you're buying something looking for 2 or 3% real yields, and the opposition parties running for the election are telling you that they're going to do away with deflation and focus on inflation, that's it. That's the end. If that happens and the swaps move, then your funding costs triple and you're out of business. They don't even know what they're asking for over there. So what I'm saying is their only hope is this homeostasis they've been in for the last 20 years, and I don't believe it can exist for many more years. It's naive for me to think that I can call the end of a 70-year debt supercycle, but it sure looks to me like in the next 2 or 3 years that they can't hang on. I'm not going to kill you with this. I'll just make a couple of points. Just to I'm going to illustrate how much of a conundrum they're in. Japan just elected today, or just announced today, their 10th finance minister in the last 6 years. It's 10th in the last 6 years. So let's see. They're selling more adult diapers than kids' diapers. There's a revolving door at the Ministry of Finance. They can't come up with any solutions to the problem. In fact, the new consumption tax hike they just voted through at the BOJ, they said they can't implement it because the economy is too soft. They haven't said that externally yet, but that's what we're hearing. So their new budget, they posted their budget for fiscal year 2012 on Christmas Eve of last year. Me being the idiot that I am, saw it on Christmas Eve and decided to look at it. And what you'll see is on the Social Security line item, on the expense line item there, first of all, you see a decrease in expenditures of roughly 2 trillion yen. That delta looks like an increase, but it's a decrease. This is right off their website. And Social Security expenditures in Japan, you'd expect to see increasing at an increasing rate. And that for the last 5 years, they've been increasing at 9.5% a year. Well, this year they cut them 8%. So instead of increasing them at 9.5%, they cut them by 8%. I thought that was interesting because I didn't see any reform to their social welfare system. So that was fascinating to me. So I got back to one of the footnotes in the presentation I have in the red box up there. And it says the pension gap for fiscal year 2012 would be financed by selling government compensation bonds. Okay, now there's a new bond. We haven't talked about those yet, and it's not a JGB, but it has pari claims to JGBs, so government bonds, which will be paid for by future radical reform of the taxation system. I mean, you have to be kidding me. So what they're telling you is the expenditure exists. They're just defeasing it from the income statement, right? They're cutting it out because they have to solve backwards for only issuing 44.5 trillion yen of bonds. So they're going to cut it out. They're going to issue a new kind of bond that they've never talked about before. And by the way, I haven't seen anything since, and this was December 24th. And the expenditure actually existed. So this shows you that they're starting with the answer, working back to the problem, and how desperate they are. When I talked to the Ministry of Finance, I said, why don't you just issue more JGBs? The guy said, we didn't want to upset the delicate balance of the JGB market. And I said, so what you're deciding to do is issue a new bond that shows a more certain path to repayment because you're going to attach a tax stream to it. So you're going to layer the JGB market that you don't want to upset the delicate balance of. And he said, you know, I didn't think about it like that. Basically, what I'm telling you is they're at the end of their rope. They don't know what to do. They don't know where to go. And this is a perfect evidence of the fact of how bad it really is in Japan. I won't get into consumption tax. That'll bore you. We created a finance minister index just to try to understand the acuity of the problem in Japan, and it's a little bit funny. And I don't think we have the new guy's not on here because he was decided this morning. And for those of you that again think about this a little more, the retail ownership of bonds in Japan is only 5%, so it's a tiny portion of their ownership of their own bonds. But look at retail ownership. You're seeing it really fall off from 5.5% to 3.5% in just a few years of the total debt stack of Japan. Well, this is what you would expect. If I was right about the demographics, what would you expect to see? You'd expect to see more people dis-saving than saving. The personal savings rate, which was as high as 18% back in 1981, is now below zero. This is how it all comes to an end. It is clear as day if you look at the numbers, if you look at the charts. In fact, the Harvard Business School took in all of our work and published a case study. I think you go to their website, you can probably buy the case. But it's the first time, to our knowledge, that Harvard Business School has ever done a case on something that hasn't happened yet. This is something that, and maybe we're all wrong about this, but I can't see how we're going to be wrong. Institutional ownership. Now, this is, again, one other point that I'll make. when the Chinese and other various nations that own peripheral European debt had to sell that debt, now, of course, all the European banks own their own debt. I don't know if that makes you feel any better or not. It doesn't make me feel any better. But what you're seeing is you saw a move up in institutional ownership, external ownership of JGBs, but it's really a parking spot, right? They bought very short-term bills and notes, and it shows up here, but it's starting to tick down a little bit. And I think these periods of time that we're entering will be punctuated by enormous cross-border capital flows. People will not know where their money is safe. I mean, we all went through that a little bit here in our own financial crisis, but these people won't know which country is safe and which country's currency to put their money in going forward. Again, these are the press releases that have been in the back pages of the Asian Wall Street Journal, on Bloomberg, on Reuters, not on CNBC in the morning, not on the front page of the New York Times with red lights going off. But if you just read what's being said by the managers of GPIF and Japan Post Bank, these were the largest buyers of Japanese bonds. They're telling you overnight that now there have to be a seller. They're sellers of 17, 18 trillion yen of bonds overnight. So now the Ministry of Finance in Japan is going into desperation mode, looking at that trail off of retail JGB ownership. They're trying to figure out how to get the population to buy more bonds. So this is directly off of their website. They've got an aggressive marketing campaign going on. They've got the champion sumo wrestler and this girl band, AKB48. It's like 100 schoolgirls singing the worst songs you've ever heard in your entire life. But they really appeal to Japanese men, and that's what they're trying to pull off, trying to get the Japanese men to buy more government bonds. But it just goes to show you, again, the case study in Japan, the posthumous study, will be so obvious to those that paid any attention to it, and it'll be obvious once it happens. What I hear as the primary response to my delivery, and of course we can get deeper in the weeds if you want to, I'm trying to keep this quick, but what I hear teaching at Harvard and speaking at various universities and the CFA institutes is, I keep hearing from the crowd why they might be able to hang on for a couple of more years. You can't dispute the quantitative analysis, it's the numbers are the numbers, but you can dispute the qualitative inputs of the participants, and maybe they might be able to hang on for a few more years. What this means is the globe is about to enter in a period of sovereign restructurings. And what does that mean to you? Well, to me, it means people are going to lose a lot of money. And it's our job to not be one of those people. And that's what we spend a lot of our time focusing on at our firm. Asian trade, I'm just going to go over the trade picture real quick because it's pretty frightening what's happening today. FX reserve accumulation, which is, of course, the trade surplus Asia runs with the rest of the world, is now tracking sub 100 billion. To put that into perspective, the last time it went sub 100 billion was 97, 98 during the Asian financial crisis. It didn't even go that low in 2008 and 9. Didn't even come close to it. And the prior time before that was 91. So it looks to us like Asian trade is literally off, and that's a direct result of European trade really slowing down and the equilibrium of wages catching up in Asia, in our opinion. But going forward, Asia's really going to be a problem. And if you look at these charts, you look at the time frames in which these things broke the zero line in the past, and those weren't great times for the world. So China's trading partner data happens to disagree with the official Chinese data. I know that's a shocker to all of you. Yeah, so anyway, you look at FX reserve accumulation, basically Asian trade surpluses coming off the map. And think about how large the Asian economy has grown from 91 to 97 to 2012, and I'm giving you an absolute dollar amount. So this is a real problem. All right, so I'm not going to belabor non-agency RMBS. We have 60% of the assets of our firm invested in subprime and Alt-A in first, second, and third pays. Brandon runs that portfolio. He's going to go over a lot of the rationale behind our thoughts with regard to non-agency RMBS. We tend to think it's the single best and safest place for your money for the next 2 or 3 years. We think that spread that Alan showed you of the agencies over treasuries, which is just unbelievably terrible, we look at that. It's funny, Brandon and I were sitting in the back when Alan put it up, and we said, it's exactly what we've been focused on. But that spread basically between agency RMBS, which is, of course, the Fed twisting, and high yield, and everything else where you see yields compressing, where REITs are now trading on 3 caps and all of this crazy stuff. Non-agency RMBS, if you know what you're doing and you know how to analyze these bonds, these are still anywhere from 6 to 12% yields, where they're bulletproof and you can't lose money. I know you've heard that before, but you can't lose money if you hang on through the duration. So we think those spreads over the next 2 or 3 years are just going to collapse. And it'll probably be in the next 12 months, not over the next 2 or 3 years. So that's where we have the majority of our capital, and Brandon will talk to you about why. So I'll stop there and tell you that what we think about the United States is some good things have happened here. And this isn't just the optimism bias with me because I live here. It's really shale gas has made us the Saudi Arabia of natural gas. We are already the Saudi Arabia of food. Our fracking process has already moved U.S. crude oil production from 5.2 million barrels to 6.2 million barrels a day, or probably more now. And the U.S. housing crisis, we think, for all intents and purposes, is close to being over. And I know there are plenty of things that need to flush through the system, and plenty more foreclosures have to go on. We don't think pricing's going down anymore, especially on the low end of the market, where you've already seen a 5% year-over-year bounce. We think U.S. housing is going to be okay. We think the U.S. economy is going to do a little bit better than the rest of the world's because our housing crisis is somewhat over. We don't think the jobs are coming back anytime soon, but we think housing is going to be better in the concentric circles surrounding housing. You guys are going to do a little bit better going forward. So that's the silver lining in the speech. And again, owning real assets and productive assets would be the place to go. So I'll stop there. I appreciate you guys listening, and I guess I can start to answer some questions with Q&A. I don't know how to scroll back. If someone will come out here and scroll back. Do you guys have the ability to enter questions on your keypads? Let me see here. Okay. Yeah, so the first one is I'm more specific on the Japan crisis time frame than I have been in the past. In the past, last year I said it's in the next 3 years. So this year I'm saying it's in the next 2, so that's pretty consistent. When they go current account negative, I think it really becomes a problem. And when the Eurozone periphery goes into its restructuring, I think that could be something that sets off the problem as well. So yeah, I think it's actually pretty consistent, but you're right, I am getting more close to trying to time things within a couple of year time frame. What European stocks should we be short? Well, you should be short all of their banks, because if they go into recapping the banks, the equity is going to get smashed just like it did here in the U.S. I know it's a precarious position, but one of our short positions in the fund is we're short Euro banks. What's the key indicator that gives you confidence U.S. housing is stabilizing? So I think about that from 2 different perspectives. One is a historical perspective. There have been 24 housing busts in OECD nations since 1980. The average time it takes to go from peak to trough is 6.25 years. And those associated with severe banking crises at 7.25 years. For all intents and purposes, we were at our peak in pricing in the U.S. in Q2 of 2006, if you use the Case-Shiller Index. We're about 6.5 years into this crisis. We've gone 36% peak to trough nationwide. It just looks to me like it's played out. The majority of those declines happen in the first 4 years. Things flatten out in the last 2 or 3. And that's what we're seeing across the board. Now, I realize that typically housing follows jobs and incomes and things like that. But with Bernanke making things as affordable as he possibly can by really twisting rates lower, and the flush that's gone on, again, there are many more things that have to happen. Another way to look at it is just through pure absorption, right? We have population growth in the U.S. of about 1.7. Household formation rates are about 1.2 million a year. We have 6 million-ish homes in inventory today and shadow inventory. We think a healthy level of housing inventory is 3.5 million homes. So if you just think about absorption, it looks to me like we have another year or 2 to get through absorption, with affordability getting a little bit better. So no matter how you triangulate this, in the next year or two, I don't think housing is going to get much worse, barring some sort of other calamitous event around the world. If it's just U.S.-centric, I tend to think that it's going to be a pretty good place to have capital invested. Yeah, so China, a lot of people want to know about China. What's my opinion of the rumbling in China about their own QE? We don't have any positions in China, but something that's interesting to me is the Chinese banking system has expanded by 50% of Chinese GDP 3 years in a row. So that's analogous, let's say, to the US lending, what, $23 trillion into our economy in 3 years through the banks. I'd take the over on 8% GDP growth for all you wanted to bet me if we did that. So I think that they've had this enormous capital infusion into their banking system. And to put things into perspective, their banks are now 3 times their GDP in their banking system, and their non-performing loans are running about 1%. Historically, during crises, their non-performing loans get up into the high 20s, low 30s. On average, for the last 20 years, the NPLs in Chinese banks have been 18, 19%. If you take 18% of 3 times GDP, and then you go look at Chinese FX reserves, that illusory pile of money that we tend to think China has is kind of gone if their NPLs spike up to 18, 19 in their banks. And that's why I found the most recent announcement of, we'll allow more foreigners to invest in our banks now. Come on in, says the spider to the fly. I said, no, we're okay. We'll let your NPLs spike up and you recap your own banks. So anyway, when I think about China, trade's falling off a cliff, which is not good for Japan or China, and the banking system NPLs are really going to pick up over the next couple of years. Not going to answer that one. Can you move down a little bit? No, the other way. Oh, we're going up. I see. Okay. Our estimate of the shadow inventory in the U.S., roughly 6 million, Brandon, plus or minus. Well, with homes that are basically going through some stage of foreclosure, and those in the full shadow inventory of NPLs in subprime and Alt-A, and on balance sheet. Yeah, let's talk about the GSEs for a second. We think that the most recent move by the Obama administration, maybe this is a little conspiratorial, we studied the GSEs pretty carefully, and we thought that if you look at their current cap structure and you look at the G fees, if they were to just raise the G fee, I don't know, 8 or 10 basis points a quarter for a few quarters and get it up to 50, 60 basis points instead of where it sits today, we think that the GSEs could pretty much pay back the loans, even though they were at 10% to the U.S. Treasury over the next few years, and earn themselves back into being. But when I meet with both sides of the aisle want a bullet in their head. And when both sides of the aisle want a bullet in your head, you're going to get a bullet in your head. And this most recent change to kind of putting the GSEs in the permanent penalty box suggests to us that one of the administration's moves going forward most likely will be principal forgiveness at the GSE level. Maybe it's an election strategy, maybe we're being too conspiratorial, but it seemed to me like what they just did by basically, again, putting them in the permanent penalty box looked to us like they're getting ready for principal forgiveness because they didn't need to otherwise do it unless they were going to take on more losses. So I think that's an interesting thing to talk about here at this conference. Where do we stand on gold? You know, we just look at gold as another currency that you can't print. I'm not a gold bug per se. I know a lot of people make us out to be one, but you know, look, even back when we were on the gold standard, if you looked at pre-World War I, you know, 1913 to 1921 dollars in terms of convertibility to gold was fixed, and yet we still had pretty big variability in purchasing power, like a 35% change in purchasing power. It's not the panacea that people think, but having our entire currency system tethered to something that's either convertible into a fixed asset, or I think something that's better, maybe tied to population growth makes a little bit more sense, but limitless credit creation is probably a bad idea. So some sort of hybrid of the current system and the more arcane system of being tied to the yellow metal is probably where we need to be. How much more time do we have? We have some more time. Look, the long-term impact of QE3, when I met with Donald Cohn when he left the Fed as the vice chairman, he told me, he said, we're not looking at QE3, we're looking at QE 4, 5, and 6 and how it's going to look like and what we're going to do. And look, when all you have is a hammer, everything looks like a nail, and that's where the Fed is today. And when Bernanke was before Congress and was thanked, and basically Congress said that look, we're in your hands, Ben should have shot back and said, no, we're actually in your hands. You guys need to implement significant fiscal policy reform, and you really need to right this ship. If all of us in this room are hoping that the Fed can restore some sort of economic prosperity, then God help us all, because they're not going to be able to do that. You know, the zero lower bound, in my opinion, is that last chapter in Keynes's book. If you go reread, I don't know how many of you have read all of Keynes's books. I've tried to just read them all. If you go to the Bible, the Keynesian Bible, it's his general theory on interest and employment and interest. You go to the index and you look up interest. There's 64 entries for interest, and not one of them says zero, and not one of them says really low or really, really low. It's just not in there. And yet, when you go to the conclusions chapter of that book, it's fascinating to me to see that in the conclusions chapter, which is pretty easy to read, I suggest you go read it, he tells you that a zero lower bound essentially would be the euthanasia of the rentier. He had a general disdain for anybody that was let's say, how does he put it? Not a worthless investor, I can't remember exactly the terminology he uses, but basically the rentier, someone that charges interest for lending money. He basically says that there should never be capital scarcity like there is land or natural resource scarcity, because we can just create capital. And in the conclusion section, he talks about the zero lower bound is knowing that's where everything's going, although he implicitly says it, not explicitly. But when you get to the zero lower bound, and if you're headed there to try to avoid a painful restructuring, well, that's the end, because you can't ever move from there. So QE3, QE4, QE5, I don't ever think we can move rates. Here's our real problem in the US. You think back to the Volcker days when we had someone come in and try to arrest successful in arresting the inflation of, call it, the late 70s and early 80s. We had 34% on-balance sheet debts to GDP, and we were spending 17% of central government tax revenue on interest in 1983. We spend 11% of central government tax revenue on interest today, and 50% of our bonds are free. I mean, they're all less than 1 year. So when Bernanke says, I'm going to keep rates low for a long time, what he means to say is low forever, because we can't ever afford to move them. If every point's going to cost you $150 billion, I don't think he can ever move it. He might be able to do a ceremonial quarter or a ceremonial half, but Volcker can't even show up today. If we move rates 500 basis points, and you multiply that by 150 billion on revenues of, roughly $3 trillion, I don't know how you do it. So when I think about QE, it's their only answer, but it's, again, this is how smart people get lulled into the path of serious debasement of the currency and hyperinflation. It'll happen. It just takes time. Let's see. How do I think about renting versus owner in the U.S. economy? I don't know. Brandon's probably better at that than I am, but I know that these, and Alan probably knows better than I do, these big portfolios that are talking about trading from the GSEs to investors on the rent-to-own strategy, I hear they're going to trade at a sub 5% cap rate. Therefore, I'm out. But I think that renting and owning, what Bernanke's clear intent is to make it as affordable as possible for those that can afford to buy. But remember, we were already at record home ownership rate, so you're not going to see this tremendous level of buying once we hit some new level of affordability. It's just going to keep churning, and we assume in the non-agency market that you're not going to see any refis going on. I think we have a CPR of almost 0 in our model, so that's not going to change going forward. We have about 1 more minute here. Yeah, isn't fear that global fixed income markets do not What's Ben? Anyway, next one, we can recapitalize our banks, but cannot capitalize underwater mortgages. Yeah, I mean, someone was asking where I'm going to digress and then I'll finish here. Someone was asking whether banks should have kind of a regulatory maximum amount of either ROA or ROE. And I'll never forget the day. If you remember, we were talking about implementing new capital standards in the banks post-crisis, and we were talking about bringing in Basel III and going to a 10% capitalization level on banks and bringing leverage down to 10 times. And I was getting dressed, and I have a TV in my closet. And at the same time that I'm hearing that we're just going to scrap that and go on to something new, this cast of the Jersey Shore is ringing the New York Stock Exchange bell. And I said, well, that's perfect. This is the nation we're living in today. We're just going to avoid that. So anyway, thank you very much for listening, and I appreciate you having me.